Ever wonder what really goes into making iconic brands like Calvin Klein and Tommy Hilfiger, especially when a company reports its financials?
Uh,
Today, we're unpacking a fresh set of earnings results. They reveal quite a bit, about strategy, brand power, and navigating this tricky global market.
yeah, we're diving deep into PVH Corp's Q2 2025 earnings and their guidance looking forward.
We'll pull out the crucial insights for you.
It's uh, it's a really fascinating look under the hood, isn't it? A major player in fashion. We've really sifted through their official Q2 report
Right.
and also pulled in analysis from places like Benzinga and investing.com, just trying to get you the clearest picture.
So the mission is to understand not just what happened, but why it matters for a company like PVH, trying to balance that brand strength with all these external pressures.
Exactly.
Okay, let's get into it. PVH Corp, the parent company, Calvin Klein, Tommy Hilfiger, big names.
Huge.
They just dropped their Q2 2025 results, and the headline, pretty strong. They largely beat expectations.
Yeah, that's the main takeaway. What really jumps out first is the revenue.
Right. Talk about that.
So total revenue for Q2, $2.167 billion. That's up 4% compared to last year.
Which beat their own guidance too, right? They were expecting low single digits.
Exactly. And it also beat the street estimates, which were around $2.12 billion. So a comfortable beat there.
Mm-hmm.
And, it's always important to look at constant currency figures.
To strip out those exchange rate effects.
Precisely. And even doing that, revenue was still up 1%. So that tells you there's some, real underlying organic demand.
Okay, and it wasn't just revenue that surprised. The earnings per share, the non-GAAP EPS, that really stood out.
It really did. They reported $2.52 per share. The analysts were looking for $2.
Wow, so $1.52 beat. That's significant. It points to some decent operational efficiency.
Absolutely. And it's worth maybe just pausing on that GAAP versus non-GAAP thing for a second.
Yeah, good idea.
So GAAP, generally accepted accounting principles. That's let's say the official unadjusted number. GAAP EPS was actually $4.63.
Okay.
But non-GAAP gets highlighted a lot because it pulls out things considered non-recurring or maybe not core to the ongoing operations. Like PVH had $45 million in pre-tax restructuring costs this quarter.
Right, so non-GAAP filters that noise out.
Exactly. It helps investors kind of evaluate the core performance, the sort of sustainable health of the business without those one-off items muddying the waters.
Makes sense. Helps you see what's really driving the engine.
Mm-hmm.
And speaking of drivers, the CEO, Stefan Larsson, he pointed to disciplined execution of our PVH Plus plan.
Their big strategic plan.
Yeah, and leaning into the iconic brand strength of Calvin Klein and Tommy Hilfiger. And you can kind of see that playing out in the brand numbers.
You really can. Take Calvin Klein. Revenue was up 5% compared to last year.
Or 3% constant currency. Still pretty good.
Yeah, and the report actually gives some specifics on what drove that. Continued growth in underwear and fashion denim. And they link it to, and this is interesting, the biggest product innovation so far, amplified by mega talent like Bad Bunny.
Wow, Bad Bunny. That shows they're really tapping into the cultural zeitgeist, doesn't it?
It really does. It's not just about the clothes, it's making them relevant.
Yeah.
These high-profile collaborations, they clearly resonate, especially with younger folks.
For sure. And Tommy Hilfiger wasn't far behind. Revenue up 4% year over year.
Though flat on a constant currency basis for Tommy.
Right. And their drivers were interesting, too. They mentioned a campaign tied to that big F1 movie.
Yeah, F1 the movie.
And also a partnership with the U.S. Sail GP racing team. It feels like very strategic lifestyle marketing, connecting Tommy to, speed, sports, global events.
Totally. It shows how smart partnerships and just staying culturally plugged in can really pay off. It's embedding the brand in experiences people actually care about, not just standard ads.
Mm-hmm. And the heritage brands.
Also saw a little bump, up 1% year over year, about $51 million. So some stability there too.
Okay, so the brands are doing well. How are they reaching customers? Let's look at channels. Direct to consumer, that's their own stores and website.
Right.
That was up 4% overall. Their own stores up 4%. Digital commerce up 3%. Solid numbers.
Solid, yeah. But here's a bit of a twist, maybe. While DTC grew, their wholesale revenue actually grew faster.
Oh, interesting. How much?
Wholesale was up 6% year over year, or 2% constant currency.
That feels a bit counterintuitive when everyone's talking about direct connection.
It does, but there's a reason. A lot of that wholesale growth came from the Americas region.
Okay.
The Americas saw a really strong 11% revenue increase overall. And a big piece of that wholesale jump was because PVH transitioned some previously licensed women's categories in-house.
Ah, okay. So they took direct control, and that boosted their wholesale figures.
Exactly. So while DTC is key for brand and maybe margins, wholesale gives you that broad market reach. It's a balancing act.
But direct-to-consumer in the Americas was flat, you said?
Yeah, flat in the Americas for DTC. So maybe some regional differences in shopping habits or perhaps market saturation.
And speaking of regions, it sounds like a mixed picture globally, which kind of underlines that uncertain global macro environment the CEO mentioned.
Definitely. Look at MEA, Europe, Middle East, Africa. Reported revenue up 3%,
Okay.
but down 3% on a constant currency basis.
Whoa. Okay. Why the difference there?
The report points to wholesale shipment timing shifts. So maybe more of a scheduling thing for the quarter rather than a fundamental demand drop, but it still hits the numbers.
Got it. And APAC, Asia Pacific.
That was down 1% reported and down 3% constant currency.
Okay, what's driving that?
Mainly a decrease in the wholesale business there. And they explicitly mention a challenging consumer environment in the region, particularly in China.
Oof, China. That's always a big one. A slowdown there really sends ripples.
It absolutely does. It impacts pretty much every global brand. So yeah, very mixed regional picture.
Okay, so some strong points, some definite headwinds. Sales look impressive in places, but profitability, that can be a different beast. Let's talk gross margin. It dropped.
It did. From 60.1% last year down to 57.7% this quarter. That's a noticeable dip.
Yeah, almost 2.5 percentage points. What's behind that erosion?
Well, the report lists a few things. One, a more promotional environment, more sales, basically.
Okay, discounts eating into margin.
Right. Then there's the margin impact from bringing those licensed products in-house we talked about. Also an unfavorable channel mix. And, a big one, increased tariffs on goods coming into the U.S.
The tariffs. We knew they'd come up.
Yeah, they're a recurring theme. Plus, they mentioned higher freight costs and some extra discounts needed because of delivery delays with Calvin Klein products.
So it sounds like they're getting squeezed from multiple sides. External stuff like tariffs and freight, but also internal strategic moves.
Exactly. It's not just one thing. It's a confluence of factors really pressuring that margin percentage. It points to the bigger challenge of managing a global supply chain right now.
That tariff impact is definitely one we need to keep tracking. What about inventory? It was up 13% compared to last year. PVH calls it a purposeful investment. Is that, always good news in fashion? Or is there a risk there? 13% feels kind of high.
That's the million-dollar question, isn't it? It's a real balancing act.
Yeah.
PVH says the increase is intentional to support the sales growth they expect in Q3 and just have better product availability, especially for core items. And to be fair, it is an improvement from Q1 when inventory was up 19%.
Okay, so the trend is improving at least.
Right. But still, in a tricky consumer environment like they mentioned in APAC, a 13% inventory rise carries risk if demand doesn't quite meet projections.
Then you're looking at more promotions, hitting margins again.
Exactly. And they also noted that about 1% of that inventory increase is just due to the higher cost because of tariffs. So the inventory itself is more expensive to hold. It's definitely a strategic gamble.
Okay. But despite these challenges, their liquidity looks strong. About $1.9 billion in cash and available borrowings. That gives them flexibility.
For sure. A good cushion.
And they did some big stock buybacks in Q1, $561 million through those accelerated share repurchase agreements.
Right. Quick way to return cash to shareholders.
But interestingly, they said they don't expect to make any more common stock repurchases for the rest of 2025. Does that signal maybe a bit more caution, shifting how they use their cash?
It certainly could. Having strong liquidity is great, but pausing buybacks might suggest they're prioritizing holding on to cash given the uncertainties we've been talking about, especially those tariffs.
Right, maybe keeping powder dry for operations or other investments.
Could be. Seems like a prudent move when the outlook is cloudy.
Okay, let's pivot then. Looking ahead, the forward guidance. CEO Stefan Larsson sounded pretty upbeat about fall.
He did. He mentioned brands being geared up, strong category focus, more product innovation, big campaigns with global talent.
Right. He expressed confidence in executing, even with that uncertain global macro environment. It's that typical CEO blend, isn't it? Confidence mixed with caution.
It really is. And the CFO, Zach Coughlin, kind of echoed that. He highlighted reaffirming their full-year earnings guidance.
Their non-GAAP guidance.
Right, non-GAAP. And doing that despite the ongoing uncertainty, including trade issues, while also increasing investment in brand building.
That's interesting. So they're not cutting back on marketing spend even with the headwinds.
Seems not. It suggests they're playing the long game, sticking to the PVH Plus plan, believing those brand investments are crucial, even if things are tough short term.
So, okay, the actual numbers for the full year 2025, they tweaked the revenue outlook slightly upwards.
Yeah, just slightly. They now expect revenue to increase slightly to up low single digits. Before it was flat to increase slightly.
Okay, so a little more optimistic on the top line.
And they reaffirmed the constant currency outlook as flat to increase slightly.
And operating margin.
Also reaffirmed, around 8.5% on a non-GAAP basis. And crucially, that number already includes the expected hit from those recently announced tariff increases.
Wow, okay, so the fact they can hold that margin steady despite the tariffs suggests their mitigation efforts are working, or the underlying business is strong enough to absorb some of it.
Seems that way. It implies some operational resilience.
And the bottom line, non-GAAP EPS.
Also reaffirmed, they're guiding for $10.75 to $11 per share for the full year.
Okay, but this is where that tariff discussion gets really concrete, right?
Yeah.
The impact on that EPS number.
Oh yeah, it's significant. That full-year EPS range includes an estimated net negative impact from tariffs of about $1.15 per share.
$1.15. That's up from their previous estimate of $0.052.
Right, and most of that impact hits in the second half of the year. Over $1 per share is a major headwind for profitability.
No kidding. They mentioned mitigation actions, but that's still a big chunk to overcome.
It absolutely is. Things like diversifying sourcing, negotiating with suppliers. They're working on it, but it's tough. On the plus side, though, they're expecting a bigger positive impact from foreign currency translation.
Oh, how much?
About $7.45 per share positive impact, up from just $0.10 previously. So that helps offset some of the tariff pain, but definitely not all of it.
Okay, so that's the full year. What about the immediate next quarter, Q3?
For Q3 2025, they're projecting revenue to be flat to increase slightly compared to last year's Q3.
But down slightly on constant currency.
Correct. A slight decrease expected on a constant currency basis for Q3.
And Q3 EPS.
The non-GAAP range is $2.35 to $2.50 per share.
And I assume tariffs play a role there, too.
Yep, that Q3 range includes an estimated negative tariff impact of about $0.25 per share for the quarter alone.
Okay.
Again, with planned mitigation. And there's a small positive currency impact expected, too, about $0.10 per share for Q3. So tariffs are biting right away, not just a full-year thing. Man, it's clear tariffs and just global trade uncertainty are massive factors for them. They even said it directly, didn't they?
They did. They put out a pretty strong statement. There is significant uncertainty with respect to global trade policies, the potential for increases in tariffs, and the related impact. As such, the company's 2025 outlook could be subject to significant material change.
That's not your usual boilerplate warning. That feels very pointed.
It really does. It's transparency, which investors need.
Yeah.
But, you could also see it as managing expectations, right? Highlighting the uncertainty, maybe sets a slightly lower bar, making future performance look even better if they navigate it well.
That's a fair point. Sets the stage.
Yeah.
So with all this news, the Q2 beat, the reaffirmed guidance, but with heavy tariff warnings, how did the market take it?
Pretty positively, actually. Benzinga reported the stock climbed nearly 5% in extended trading after the announcement.
Okay, so a decent pop. It seems like the market focused more on the Q2 beat and the fact they held the full-year guidance steady, despite the headwinds. I think so. It signals resilience. Benzinga specifically called out the Q2 EPS beat $2.52 versus the $2 estimate, and the revenue beat $2.17 billion versus $2.12 billion. Those hard numbers often carry a lot of weight initially.
Right. But it's interesting you mentioned different analysis sources. Investing.com had a slightly different take on the future guidance comparisons.
Yeah, this is a really important nuance. Investing.com also reported the Q2 beats. No problem there. But when they discussed the forward guidance, their comparisons were, let's say, pointing to different timelines or consensus figures.
How so?
Well, for example, Investing.com noted, and I'm quoting the report, PVHC's Q3 2026 EPS of $2.35, $2.50 versus the analyst consensus of $2.94, and PVHC's FY 2026 EPS of $10.75, $11 versus the analyst consensus of $10.48.
Wait, 2026? But PVH was giving guidance for Q3 2025 and full year 2025.
Exactly. That's the crucial distinction. So according to Investing.com's reporting and the consensus figures they cited for 2026, PVH's Q3 outlook seemed below that consensus, while the full year 2026 outlook was above that consensus.
Okay, so it really highlights how you have to be careful about matching the guidance period with the right consensus estimates for that specific period. You can't just mix and match years.
Precisely. It shows the complexity. PVH reaffirmed their 2025 guidance, which was mostly in line or slightly better than their own prior guidance. But how that stacks up against different analyst views for future years like 2026 is a separate and potentially confusing comparison if you're not careful.
Got it. Super important context. Okay, so let's try and pull this all together. What are the big takeaways from this deep dive into PVH?
Well, first, I think it really shows that their PVH Plus plan, focusing on that brand strength and innovation, the Bad Bunny effect, the F1 tie-ins, it's working. It clearly helped drive that solid Q2 performance.
Yeah, proof that strong brands, marketed smartly, can still cut through.
Definitely. But second, that challenge of tariffs and the whole global trade situation, it's not just noise, it's like a fundamental pressure. You see it hitting margins, inventory costs, shaping their entire forward outlook.
And their mitigation actions are clearly a major strategic focus now. It's about navigating this really difficult external environment.
For sure. And third, just reiterating the importance of those constant currency numbers. They really help you see the underlying business health, stripping out the FX volatility.
Right.
Essential for getting a clear picture.
Right. So wrapping up, what have we learned?
We've learned that PVH executed well in Q2. Calvin Klein, Tommy Hilfiger, performing quite well, driven by that marketing and innovation push.
They're guiding confidently for growth, relatively speaking.
Yeah, but they're also being really upfront about the big headwinds tariffs, the macro uncertainty. It feels like a company that knows its strengths, but is also fighting hard against some tough external currents. Powerful brands, but operating in a pretty challenging world right now.
Okay, so here's a final thought for you to consider. PVH says they're on this multi-year journey to build Calvin Klein and Tommy Hilfiger into the most desirable brands in the world. But think about how these shifting global trade policies, the tariffs, might force giants like PVH to constantly reinvent not just their products, but maybe their entire supply chain strategy. What does that mean for the prices we end up paying, or even, where our favorite clothes actually come from in the future?
That's a huge question. It's a challenge that's going to ripple way beyond just PVH through the whole industry. Something to definitely keep an eye on.